Listen to this and you will transform from someone who is confused by financial markets into a confident investor who understands how wealth is created in the stock market. You will learn the fundamental secrets that millionaires use. You will discover the hidden patterns that drive stock prices. Most importantly, you will know exactly what to do with your money starting today. Welcome to the complete guide to understanding the entire stock market. This is not theory. This is practical knowledge that will change your financial future. Let me take you on a journey through the world of stocks, from the very basics to advanced strategies that professional investors use every single day. First, let us start with the most fundamental question. What exactly is a stock? A stock is simply a piece of ownership in a company. When you buy a stock, you become a part owner of that business. Imagine your favorite company, the one whose products you use every day. If you buy one share of that company, you own a tiny fraction of everything that company has. You own a piece of their buildings. You own a piece of their equipment. You own a piece of their future profits. This concept changed the world. Before stocks were invented, you could only make money if you owned an entire business yourself. You needed massive capital. You needed connections. You needed luck. Then stocks were created and everything changed. Suddenly, ordinary people like you could own pieces of multiple businesses. You could invest in 10 different companies with just $1,000. You could build wealth without being born into a rich family. The stock market is simply the place where these pieces of ownership, called shares, are bought and sold. It is a marketplace, just like a farmer's market, but instead of trading vegetables, people trade ownership pieces of companies. The stock market has been around for hundreds of years. It started in Europe centuries ago. It evolved into the massive global system we see today. Now let us talk about why stocks exist at all. Companies need money to grow. A new tech startup needs capital to build their product. An established retailer needs money to open new stores. They have two main ways to get this money. They can borrow from banks, which creates debt, or they can sell pieces of themselves to the public through stocks, which raises equity. When a company decides to go public by selling stocks, they hold something called an initial public offering, or IPO. This is the first time regular people can buy shares of that company. Before the IPO, only the founders and maybe some investors own pieces of the company. After the IPO, anyone with a brokerage account can buy shares. Let me explain why this matters to you personally. When you own a stock, you become entitled to two things. First, you might receive dividends. A dividend is a portion of company profits paid directly to shareholders. Not all companies pay dividends. Young growth companies often reinvest all profits back into the business, but mature, established companies often pay dividends to reward shareholders. Second, you benefit from capital appreciation. This is the increase in stock price over time. If you buy a stock at $50 and it rises to $75, you have made a profit. This profit only becomes real when you sell, but the potential is always there. Now let us understand how stock prices are determined. This is where it gets fascinating. Stock prices are determined by supply and demand, just like any other marketplace. If thousands of people want to buy a particular stock but only a few people are selling, the price goes up. If many people are selling but few want to buy, the price drops. But what drives this supply and demand? It is investor sentiment based on company performance and future expectations. If a company reports strong earnings, meaning they made more profit than expected, investors get excited. They want to buy more shares. The stock price rises. If a company misses earnings expectations, investors lose confidence. They sell their shares. The stock price falls. This is why news and announcements matter so much in the stock market. When a company announces new products, partnerships, or strong financial results, stock prices often jump. When negative news comes out, prices often drop. But here is something important to understand. The stock market is not always rational. Sometimes stocks rise or fall based on emotion and hype rather than fundamental business performance. Let us talk about the different types of stocks. The primary division is between common stocks and preferred stocks. Most investors deal with common stocks. When you own common stock, you have voting rights in the company. You can vote on board members and major corporate decisions. You also have the right to any dividends the company decides to pay. Preferred stocks are different. Preferred stockholders do not have voting rights, but they have priority when it comes to dividends and assets. If the company goes bankrupt, preferred shareholders get paid before common shareholders. Preferred stocks are less common for individual investors. They are more popular with institutional investors looking for stable income. Another important classification is between growth stocks and value stocks. Growth stocks are companies expected to grow earnings much faster than the overall economy. Think of tech companies, biotech firms, or innovative startups. These companies often do not pay dividends because they reinvest all profits into growth. Growth stocks are volatile. Their prices can swing dramatically, but if you pick the right ones, returns can be enormous. Value stocks are different. These are companies trading at lower prices relative to their earnings or assets. Maybe the market has overlooked them. Maybe they operate in unfashionable industries. A value investor buys these stocks, believing the market will eventually recognize their true worth. Value stocks tend to be less volatile. They often pay dividends. Returns tend to be slower but more steady. Then there are dividend stocks. These are mature companies that have stopped growing rapidly but generate consistent profits. They return much of those profits to shareholders through dividends. If you want passive income from stocks, dividend stocks are your answer. Real estate investment trusts, utility companies, and established blue-chip corporations often pay excellent dividends. Now let us talk about the major stock market indices. An index is a collection of stocks grouped together to represent a portion of the overall market. The three most important indices in the world are the S&P 500, the Dow Jones Industrial Average, and the Nasdaq. The S&P 500 includes 500 large-cap companies. These are the biggest companies in the country by market capitalization. Market capitalization means the total value of all outstanding shares. If a company has 50 million shares outstanding and each share costs $100, the market cap is $5 billion. The S&P 500 includes companies like Apple, Microsoft, Amazon, and thousands of others. It represents about 80% of the total stock market value. When people talk about how the stock market is performing, they usually mean the S&P 500. The Dow Jones Industrial Average includes only 30 companies. It is much smaller and more selective. These are the absolute bluest of blue-chip stocks. Companies like Coca-Cola, McDonald's, and ExxonMobil. The Dow is weighted by stock price, so more expensive stocks have more influence. The Dow is the oldest index and has historical significance, but professional investors consider it less representative than the S&P 500. The Nasdaq is different. It specializes in technology companies. It includes companies like Apple, Microsoft, Tesla, and countless smaller tech firms. The Nasdaq is more volatile than the S&P because technology stocks tend to swing more dramatically. If you want exposure to tech stocks, the Nasdaq is your benchmark. Understanding indices is crucial because they help you assess your investment performance. If your personal portfolio returns 8% over a year, but the S&P 500 returned 10%, you underperformed. You should adjust your strategy. If you returned 12% while the index returned 10%, you outperformed. You are doing something right. Now, let us discuss how stocks are traded. In modern times, trading is electronic and nearly instant. If you want to buy 100 shares of a company, you use a brokerage app or website. You enter your order. Within seconds, your order is matched with someone selling those shares. The transaction completes. Your brokerage account shows the new shares. This happens millions of times per day across the world. There are different types of orders you can place. A market order buys or sells immediately at the current price. If you place a market order to buy, it will fill at whatever the lowest asking price is right now. Market orders are simple and quick, but you do not know the exact price until after the purchase completes. A limit order lets you specify a price. If you place a limit order to buy 100 shares at a maximum of $50 per share, your order only fills if the stock drops to $50 or lower. If it never reaches that price, your order never fills. Limit orders give you control over price, but your order might never execute. A stop-loss order is designed to protect you from big losses. You set a price, and if the stock falls to that price, your shares automatically sell. If you bought a stock at $100 and set a stop-loss at $80, your stock will automatically sell if it drops to $80. This limits your loss to 20%. Stop losses are essential for risk management. Day traders use more sophisticated orders and trade frequently, sometimes dozens of times per day. Swing traders hold positions for days or weeks. Position traders hold for months or years. Long-term investors hold for decades. As a beginner, you should think like a long-term investor. Do not try to time the market with frequent trades. The data shows overwhelmingly that long-term investors outperform traders. Let us talk about valuation. How do you know if a stock is expensive or cheap? The primary metric is the P/E ratio, which stands for price to earnings ratio. This is the stock price divided by the annual earnings per share. If a stock costs $100 and the company earned $5 per share last year, the P/E ratio is 20. This means investors are paying $20 for every $1 of annual earnings. A low P/E ratio might indicate an undervalued stock. A high P/E ratio might indicate an overvalued stock. But this depends on context. Tech stocks typically have high P/E ratios because investors expect rapid growth. Utility stocks have low P/E ratios because investors expect steady but slow growth. You cannot simply compare P/E ratios across different industries. Another important metric is earnings per share, or EPS. This tells you how much profit the company generated per share. If a company earned $1 million in profit and has 100,000 shares outstanding, the EPS is $10. Companies that consistently grow earnings are rewarded with higher stock valuations. The price-to-book ratio is another valuation tool. Book value is the company's assets minus liabilities divided by shares outstanding. If a stock trades at 1/2 its book value, it might be a bargain. If it trades at 5 times book value, it might be overpriced. Again, context matters. Service-based companies have low book values because they have few physical assets. Manufacturing companies have high book values. Return on equity, or ROE, measures how efficiently a company uses shareholder money to generate profit. If a company has $1 billion in shareholder equity and earns $100 million in profit, the ROE is 10%. Higher ROE is better because it means the company squeezes more profit from each dollar of shareholder investment. Now let us discuss risk. This is absolutely crucial. No investment is without risk. The relationship between risk and reward is fundamental. Lower risk investments offer lower returns. Higher risk investments offer higher returns. Your job is to find the right balance for your situation. The stock market has volatility. This means prices fluctuate. In good years, stocks rise. In bad years, they fall. On average, the stock market returns about 10% per year over long periods, but this average masks huge variation. Some years, stocks return 30%. Some years, they fall 20%. This is normal. This is expected. If you cannot handle seeing your portfolio drop by 20% without panicking and selling, you have too much in stocks. You need more stable investments like bonds. Conversely, if you have decades until retirement and can stomach volatility, stocks are your best friend. They offer the highest long-term returns of any investment class. Let us talk about diversification. This is the most important risk management tool. The saying goes, do not put all your eggs in one basket. If you buy only one stock and that company fails, you lose everything. If you buy 100 stocks from different industries, one company's failure barely dents your portfolio. There are different ways to diversify. You can buy stocks from different industries. You can buy stocks from different countries. You can buy stocks of different sizes. You can mix stocks with bonds and other assets. The goal is to reduce your overall risk without sacrificing returns. Many investors use a strategy called buy and hold. You diversify across many stocks through index funds or ETFs. You buy and hold for years or decades. You do not try to time the market. You do not panic sell during downturns. Historically, this strategy massively outperforms active trading. Index funds and ETFs deserve special mention. An index fund is a mutual fund that tracks an index like the S&P 500. If you buy an S&P 500 index fund, you own small pieces of all 500 companies. You get instant diversification. Your returns will track the overall market. This is perfect for beginners. ETFs are exchange-traded funds. They work like index funds but trade like stocks. You can buy and sell them anytime during market hours. They offer the same diversification as index funds but with more flexibility. Most experts recommend beginners start with broad index ETFs like S&P 500 ETFs or total market ETFs. Now let us discuss bonds and how they fit into your portfolio. Bonds are loans. When you buy a bond, you lend money to a company or government. They promise to pay you interest and return your principal on a specific date. Bonds are safer than stocks. They offer lower returns. If a company goes bankrupt, bondholders get paid before stockholders. The relationship between stocks and bonds is important. When stocks are rising, bonds often stay flat. When stocks are falling, bonds often rise. This negative correlation makes them excellent for diversification. A portfolio with 70% stocks and 30% bonds is less volatile than all stocks. As you get older, financial experts typically recommend shifting toward more bonds and fewer stocks. A young person with 40 years until retirement might have 95% stocks and 5% bonds. Someone 10 years from retirement might have 60% stocks and 40% bonds. Someone in retirement might have 40% stocks and 60% bonds. The bond market is enormous, larger even than the stock market, but individual bonds require more expertise to evaluate. For most investors, bond index funds or bond ETFs are the best choice. They offer diversification and professional management. Now let us talk about fees. This might seem boring, but fees are absolutely critical. If you pay high fees, your returns get crushed. An investment that returns 10% per year with 5% in fees gives you only 5%. Over decades, this compounds into a huge difference. Actively managed mutual funds charge 1% or more in annual fees. Index funds typically charge 0.1% or less. Exchange-traded funds often charge even less. If you buy individual stocks, you might pay a trading commission per transaction, though many brokers now offer commission-free trading. Consider a simple example. You invest $100,000. Option 1 is an actively managed fund charging 1% yearly. Option 2 is an index fund charging 0.1% yearly. Both return the stock market average of 10% before fees. After 40 years, the actively managed fund grows to about $1.9 million. The index fund grows to about $3.8 million. By paying lower fees, you have nearly double the money. This is not theory. This is math. Expense ratios matter enormously. Always check the expense ratio before buying any fund. Choose the lowest cost option that matches your investment goals. This is one of the few things in investing where you have complete control. Let us talk about dollar cost averaging. This is a strategy where you invest a fixed amount regularly, regardless of stock prices. Instead of trying to time the market perfectly, you buy some shares every month. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. Over time, this averages out to reasonable prices. Many people use automatic investments through their employer retirement plans or through their brokerage. Every month, they invest the same amount. They never think about it. They never try to time the market. And statistically, they end up with excellent results. This simplicity and discipline is often more important than complex strategies. Speaking of retirement plans, let us discuss them. In many countries, employers offer retirement plans where you can invest pre-tax money. In the United States, this is commonly a 401k plan. Money goes in pre-tax, reducing your current taxes. The investments grow tax-free. You pay taxes only when you withdraw in retirement. This tax deferral is incredibly valuable. Some employers match your contributions. If you contribute 6% of your salary, the employer contributes 6%. This is free money. You should absolutely take advantage of this. It is a 100% instant return on your money. Individual retirement accounts, or IRAs, are another tax-advantaged option. You can contribute a limited amount yearly to an IRA. The money grows tax-free or tax-deferred. IRAs are excellent for saving beyond what your employer offers. The power of compound growth cannot be overstated. Albert Einstein called it the eighth wonder of the world. If you invest $1,000 per year, starting at age 25 in an account returning 10% yearly, by age 65 you will have about $1.6 million. If you wait until age 35 to start, you will have only about $380,000. Those 10 years cost you over $1 million in retirement money. Start investing early. Now let us talk about sectors. The stock market breaks into different sectors or industries. Understanding sectors helps you see patterns and diversify properly. Major sectors include technology, healthcare, financials, consumer goods, industrials, energy, utilities, materials, real estate, and communication services. Technology stocks have been the star performers for years. Companies like Apple, Microsoft, Google, and Amazon drive index returns. Technology companies tend to have high growth rates and high valuations. They are volatile but offer the best long-term growth. Healthcare stocks include pharmaceutical companies, medical device makers, and healthcare service providers. Healthcare is defensive. People need medical care in good times and bad times. Healthcare stocks often perform well during recessions. Financial stocks include banks, insurance companies, and investment firms. Financial stocks tend to do well when the economy is growing and interest rates are rising. They suffer during recessions. Consumer goods companies sell products people use daily, like food, beverages, and household items. These are defensive stocks. People keep buying consumer goods even during recessions. They tend to pay good dividends. Industrial companies make machinery, equipment, and products for other businesses. Industrial stocks rise and fall with economic cycles. They do well during expansions and suffer during recessions. Energy companies extract and sell oil, gas, and other energy sources. Energy stocks are cyclical and volatile. They depend on commodity prices. Some investors avoid energy due to climate concerns. Utility stocks provide electricity, water, and gas to consumers. Utilities are highly stable and defensive. They pay good dividends. Returns are lower but very predictable. Material companies mine and process raw materials like metals and minerals. Material stocks are cyclical and volatile. They depend on commodity prices and economic growth. Real estate stocks, often as real estate investment trusts, own and manage properties. They generate income from rents and must pay most profits to shareholders as dividends. Real estate stocks are less correlated with stock prices, providing diversification. Communication services. Companies include media, telecommunications, and social media firms. These stocks are somewhat defensive and often pay dividends. For most investors, sector allocation happens automatically when you buy broad index funds. The S&P 500 automatically gives you exposure to all sectors in proportion to their size. If you want to overweight or underweight certain sectors, you can buy sector-specific ETFs. Let us discuss market cycles. The stock market moves in cycles. This is inevitable and normal. The typical cycle goes like this: recovery, expansion, peak, recession, trough, and repeat. During recovery, the economy is growing slowly from a recession. Stock prices rise. Expansion is faster growth. Companies make record profits. Stock prices rise even more. Investors become euphoric. At the peak, valuations are stretched. Everyone believes prices only go up. Then reality hits. The economy slows. Companies miss earnings. Investors panic. Prices fall. The recession deepens. Stocks reach a trough. Prices are dirt cheap. Investors are terrified. Then the cycle begins again. Recovery starts. Prices rise from the bottom. Throughout history, this cycle has repeated countless times. The key insight is that this is normal. Markets always recover. The longest bull market in history lasted 11 years. The deepest recession lasted 4 years. No crash lasts forever. The best investors buy when everyone else is terrified and prices are at troughs. They sell or at least stop buying when everyone is euphoric and prices are at peaks. Most investors do the opposite. They buy when prices are high and everyone is excited. They panic sell when prices are low and everyone is terrified. This is why most investors underperform. If you can maintain discipline and stick to your investment plan through multiple cycles, you will become wealthy. This is not complicated. It requires patience and discipline, not intelligence or complicated strategy. Let us talk about what causes market crashes. Understanding this helps you avoid panic. Market crashes happen when investor sentiment shifts suddenly from positive to negative. Sometimes this shift is based on real economic problems. Sometimes it is based on fear and pessimism. Often both are involved. The stock market crash of 1929 wiped out millions of investors. The Great Depression followed. The crash of 1987 saw the market fall 22% in a single day. The internet bubble of 2000 saw tech stocks fall 70%. The financial crisis of 2008 saw the market fall over 50%. Yet every single time, the market recovered and reached new heights. Market timing is nearly impossible. Legendary investor Warren Buffett has tried to pick the best time to invest. Even he admits this is nearly impossible. He says a famous quote, "It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Now, let us talk about some famous investors and their strategies. Warren Buffett is perhaps the most famous. He focuses on value investing. He buys wonderful companies trading at reasonable prices. He holds for decades. He reads constantly. He studies businesses deeply. He ignores short-term market noise. This strategy made him one of the richest people in the world. Peter Lynch is another famous investor. He managed a mutual fund that beat the market for 13 consecutive years, an incredible achievement. He looked for wonderful companies growing at reasonable prices. He said, "Everyone has an advantage. You know your city, your industry, your hobbies. Find great companies in areas you understand." George Soros is known for understanding macroeconomic trends. He makes large bets on currencies and markets based on his economic outlook. His approach is more complex and dangerous than value investing. Ray Dalio developed the concept of Bridgewater principles. He believes in radical transparency, bringing in smart people from different backgrounds to challenge ideas. He builds portfolios that work in different economic scenarios. For most people, these complex approaches are not necessary. Buy low-cost diversified index funds. Invest consistently. Ignore short-term noise. Wait decades. You will outperform most professional investors. This is the boring secret that the financial industry does not want you to know. Let us discuss initial public offerings, or IPOs. When a private company decides to go public, they hold an IPO. This is the first time the public can buy shares. IPOs can be exciting. Sometimes new companies double or triple on the first day. Sometimes they crash. The risk with IPOs is that new public companies are unproven. As public companies, they face tremendous scrutiny and pressure. Many young companies stumble after going public. Many IPO investors buy at the peak of excitement right before crashes. For most investors, IPOs are best avoided. Let the stock settle for years before investing. Buy established public companies with proven track records. You will have better returns with lower risk. Penny stocks deserve a warning. These are stocks that trade for less than $5 per share. They sound cheap and attractive. Many investors think they can make a fortune buying thousands of penny stocks. This is rarely true. Penny stocks are risky. Many are barely traded. Some are scams. Most investors lose money on penny stocks. Leverage is another dangerous tool. Some investors borrow money to invest. If the market rises, your gains are amplified. If it falls, your losses are amplified. Many investors have been wiped out by using leverage at the wrong time. Most beginners should avoid leverage. Short selling is when you borrow shares, sell them immediately, hoping to buy them back cheaper later. If the stock price falls, you profit. If it rises, you lose. Short selling is dangerous, expensive, and unnecessary for most investors. Stick to buying stocks you believe will rise. Options are derivatives that give the right to buy or sell stocks at specific prices. Options can be used for hedging or speculation. They are complex and dangerous for beginners. Avoid options until you fully understand them and have substantial capital. Let us talk about taxes. When you make money in stocks, you owe taxes. If you hold a stock for less than 1 year and sell at a profit, it is taxed as short-term capital gains. These are taxed as ordinary income at your marginal tax rate, potentially up to 37%. If you hold a stock for more than 1 year and sell at a profit, it is taxed as long-term capital gains. Long-term capital gains are taxed at only 15% or 20% depending on your income. This huge difference is why long-term holding is superior to frequent trading. You pay less taxes. Dividend income is also taxed. Qualified dividends are taxed at the favorable long-term capital gains rates. Unqualified dividends are taxed as ordinary income. This is another reason dividends make sense for patient long-term investors. Tax loss harvesting is a technique where you sell losing positions to offset gains. If you have a stock up $100, you sell a stock down $50. Your net gain is only $50. You owe less taxes. You can use losses to offset gains and reduce your tax bill. In retirement accounts like 401ks and IRAs, you do not pay taxes on gains until you withdraw. This makes retirement accounts extremely valuable. Always maximize contributions to these accounts before investing in taxable accounts. Now, let us talk about international investing. The stock market extends worldwide. Many of the best companies are outside the United States. Growing companies exist in every country. International stocks can reduce country-specific risk. They offer currency diversification. Many investors use home country bias. They invest only in their home country. This is suboptimal. Experts recommend that your portfolio matches the global market. If the United States is 45% of global market cap, you should have 45% in United States stocks. This requires international investing. Emerging markets are a special category. These are countries with developing economies that are growing rapidly. Examples include Brazil, India, and Vietnam. Emerging markets offer high growth potential but also high volatility. They are riskier than developed markets. Investing in international stocks is easier than ever. International index ETFs let you buy the entire developed or emerging world with one fund. Currency fluctuations add complexity, but this is manageable for long-term investors. Let us discuss how to get started actually investing. First, open a brokerage account. This is an account with a company that lets you buy and sell stocks. Many brokers offer apps and free trading. Some popular brokers include Fidelity, Vanguard, Charles Schwab, and others. Comparison shop and choose one that fits your needs. Second, fund your account. Move money from your bank to your brokerage account. This takes a few days to process. Some brokers offer automatic investment where money transfers and invests automatically every month. Third, decide on your allocation. If you are young and comfortable with risk, maybe you want 85% stocks and 15% bonds. If you are older or risk-averse, maybe it is 60% stocks and 40% bonds. Your allocation depends on your timeline, risk tolerance, and goals. Fourth, choose your investments. For beginners, I recommend 3 or 4 diversified ETFs. A total United States stock market. ETF gives you thousands of companies. A total international stock market ETF gives you thousands more. A bond ETF provides stability. Maybe a real estate ETF for diversification. This simple portfolio covers all major asset classes. Fifth, set up automatic investments. Every month, automatic amounts invest from your checking account. This enforces discipline. You do not try to time the market. You do not think about it. The money flows automatically. Sixth, ignore short-term noise. Markets fluctuate daily. Do not check your account constantly. Do not panic when markets fall. Do not get excited when they rise. Check your portfolio maybe once per quarter. Rebalance once per year. Otherwise, leave it alone. Seventh, educate yourself continuously. Read books on investing. Listen to podcasts. Take online courses. The more you learn, the better decisions you make. But remember that simple strategies beat complex ones most of the time. Let us talk about common mistakes that investors make. First is trying to time the market. Investors think they can predict when to buy and sell. They cannot. Even professionals cannot. The market is too complex and unpredictable. History shows that missing the 10 best days in the market over a 20-year period cuts your returns in half. By trying to time the market, you likely miss the good days. Second is emotional investing. Fear and greed drive poor decisions. Fear makes you sell after crashes when prices are lowest. Greed makes you buy after rallies when prices are highest. Discipline beats emotion. Stick to your plan. Third is concentrating in too few stocks. If you pick 3 stocks and one goes bankrupt, you lose a third of your portfolio. Diversification removes this unnecessary risk. Fourth is paying high fees. Fees destroy returns. Choose the lowest cost options. Avoid actively managed funds unless you have a very good reason. Fifth is not rebalancing. If you start with 60% stocks and 40% bonds, the stock allocation might drift to 75% as stocks outperform. This increases your risk. Rebalance once yearly to return to your target allocation. Sixth is panic selling during crashes. This locks in losses at the worst time. Markets always recover. Staying invested through crashes is actually when you make the most money because you buy at low prices. Seventh is copying famous investors blindly. Just because Warren Buffett bought a stock does not mean you should. You do not have his decades of experience and research capability. Stick to diversified investing. Eighth is not starting early. Time is your greatest asset. Starting at age 25 versus 35 makes $1 million difference over a lifetime. Do not wait for perfect conditions. Start now with whatever you have. Now let us discuss retirement planning more deeply. Most people want to retire at some point and have enough money for that retirement. How much do you need? The general rule is the 4% rule. If you have $1 million, you can withdraw 4% yearly or $40,000. If you have $2 million, you can withdraw $80,000 yearly. You adjust for inflation yearly. This money should last your entire retirement. The 4% rule is based on historical stock and bond returns. It is not guaranteed, but it is reliable. Working backward, if you want to withdraw $40,000 yearly in retirement, you need $1 million. If you want to withdraw $80,000 yearly, you need $2 million. How do you reach these numbers? You need to save and invest consistently. If you save $10,000 yearly and achieve 10% returns, after 40 years you will have about $3.5 million. If you save $5,000 yearly, after 40 years you will have about $1.7 million. The formula is simple. More saving plus more time equals more wealth. Social Security and pensions provide some retirement income, but for most people it is not enough. You need to save in retirement accounts and invest in the stock market. The sooner you start, the less you need to save yearly because compound growth does the heavy lifting. Let me paint a picture of what your life could look like if you start investing now. Imagine you are 25 years old. You start investing $1,000 monthly in a diversified portfolio. The market returns 10% yearly on average. After 5 years, you have about $80,000. After 10 years, you have about $200,000. After 20 years, you have about $800,000. After 40 years, you have about $6.3 million. Now imagine you do not start until age 35. You invest the same $1,000 monthly. After just 10 years of investing, you have about $200,000. After 30 years, you have about $3.8 million. You invested $10,000 more over the same period, but you ended up with $3 million less. This is the power of time. Or imagine you never start. You reach age 65 with nothing. You depend entirely on Social Security. You are stressed about money. Your retirement years are constrained by financial worry. This is the path many people take. But it does not have to be you. If you start investing now, even with just a few $100s monthly, you set yourself up for financial freedom. You can retire early. You can retire comfortably. You can pursue the career and lifestyle you want without financial desperation. Let us talk about behavioral finance. This is the study of how psychology affects investing. Our brains are not wired for rational investing. We are wired for survival. We feel fear and greed intensely. These emotions lead to poor decisions. Loss aversion is a well-studied phenomenon. People feel the pain of losses about twice as strongly as the pleasure of gains. This causes investors to sell winners to lock in gains and hold losers hoping to break even. This is backward. You should hold winners and sell losers. Recency bias is our tendency to overweight recent events. If the market has risen for 3 years, we think it will keep rising forever. If it has fallen for 1 year, we think it will keep falling. Markets are mean reverting. After big rises, corrections often follow. After big falls, rebounds usually follow. Herding is our tendency to follow the crowd. When everyone is buying stocks, we feel pressure to buy. When everyone is selling, we panic sell. But the crowd is often wrong. The best investments are often contrarian, going against the crowd. Overconfidence leads us to think we are better than we are. Many investors think they can beat the market despite evidence that most cannot. This causes them to trade too much and pay too much in fees. Confidence is good, but overconfidence is dangerous. Confirmation bias is our tendency to seek information confirming our existing beliefs. If we own a stock, we listen to positive news and ignore negative news. We should actively seek opposing viewpoints. The best defense against these biases is discipline and systems. Follow a plan. Do not deviate based on emotion. Use automatic investing so you do not think about it. Read opposing viewpoints. Stay humble. Let us talk about the different types of stocks available. Blue chip stocks are the highest quality companies, market leaders with decades of success. Apple, Coca-Cola, and Microsoft are examples. Blue chips are relatively stable and often pay dividends. Large cap stocks are companies with market caps exceeding $10 billion. Most index funds are large cap. Large caps are established and relatively stable. Mid-cap stocks have market caps between $2 billion and $10 billion. Mid-caps are less stable than large caps but offer more growth potential. Small-cap stocks have market caps under $2 billion. Small caps are more volatile and riskier but offer the highest growth potential. Micro-cap stocks have market caps under $300 million. Micro-caps are extremely risky and volatile. Most investors should avoid micro-caps. These are where penny stocks and high-risk speculation live. Growth stocks are expected to grow earnings much faster than the average. They are usually profitable but reinvest profits into growth. Growth stocks are volatile but offer the highest long-term returns. Value stocks trade at prices below their intrinsic worth. Value investors search for bargains, companies the market has overlooked or penalized unfairly. Value stocks tend to be less volatile and offer steady returns. Dividend aristocrats are companies that have raised dividends for at least 25 consecutive years. These are ultra-reliable dividend payers. Examples include Procter & Gamble, Coca-Cola, and McDonald's. These stocks are excellent for long-term investors seeking income. Cyclical stocks are sensitive to economic cycles. They do well in expansions and poorly in recessions. Examples include automobiles, construction, and retail. Cyclical stocks are volatile and require timing. Defensive stocks are resilient regardless of economic conditions. Examples include utilities, healthcare, and consumer staples. People need electricity, medicine, and food in good times and bad. Defensive stocks rise slower but fall less. Now let us discuss some investment vehicles and strategies. A stock screener is a tool that filters stocks based on criteria you choose. You might screen for stocks with P/E below 20, dividend yield above 3%, and revenue growth above 10%. Screeners help you find candidates to research. Fundamental analysis is researching a company deeply to understand its business, finances, and future prospects. You read financial statements, listen to earnings calls, and understand the industry. Fundamental analysis helps you find undervalued stocks. It is time-consuming but rewarding. Technical analysis uses charts and patterns to predict future prices. Some investors swear by technical analysis. Academic research is skeptical. Technical analysis is more art than science. Most beginners should avoid it. Dollar-cost averaging is investing a fixed amount regularly. You buy every month regardless of prices. This automatically buys more shares when prices are low and fewer when prices are high. DCA removes timing risk. Factor investing focuses on investing in stocks with specific characteristics that history shows have higher returns. Value stocks, momentum stocks, and small-cap stocks historically outperform. Factor investing is a more sophisticated approach to stock selection. ESG investing filters. Stocks based on environmental, social, and governance factors. If you care about these issues, ESG investing lets you align your investments with your values. Be aware that ESG criteria are subjective and sometimes used for marketing. Now let us address some common questions. Should I invest a lump sum or dollar-cost average? If you have a large amount of money, research shows that lump sum investing beats dollar-cost averaging over time. Prices tend to rise on average, so investing immediately beats spreading it out. But if lump sum investing makes you uncomfortable, DCA is fine. Psychological comfort matters. Should I pick individual stocks or funds? Most people should use funds. Even legendary stock pickers like Warren Buffett recommend index funds for most investors. If you enjoy stock picking and have time, you can hold some individual stocks. But your core portfolio should be diversified index funds. How much can I realistically return yearly? Do not expect to beat the stock market. Historically, the stock market returns about 10% yearly. Some years it returns 30%. Some years it loses 20%. If you beat the market, you are fortunate. If you match the market with low-cost index funds, you are doing better than most investors. Can I get rich investing in stocks? Yes, but it takes time. If you invest consistently for decades, starting with small amounts and letting compound growth do the work, you will become wealthy. This is not get rich quick. It is get rich slowly but surely. What if I make a mistake? Everyone makes mistakes investing. You will buy some stocks that perform poorly. You will miss great opportunities. You will make emotional decisions you regret. This is normal and expected. The key is to not make catastrophic mistakes. Use diversification. Control fees. Do not use leverage. Stick to boring, simple strategies. Is it too late to start investing? It is never too late. Even if you are 40 years from retirement, investing now helps. You cannot undo the past, but you can shape the future. Start immediately. Should I invest in my country or internationally? Experts recommend global diversification. Your portfolio should include stocks from many countries across developed and emerging markets. This reduces country-specific risk. Many countries grow faster than home countries. Let us talk about market sectors that are expected to grow. Technology continues to evolve. Cloud computing, artificial intelligence, and cybersecurity are growth areas. Healthcare spending increases as populations age. Renewable energy is growing due to climate concerns and cost decreases. Emerging markets offer growth as billions transition to middle-class status. These areas offer long-term growth opportunities, though no growth is guaranteed. Now, let us discuss investment strategies for different life stages. In your 20s and 30s, you have decades until retirement. You can afford to take risk. Go 85 to 100% stocks. Take extra risk if you are comfortable. This is when you build your wealth foundation. In your 40s, reduce stock exposure slightly to 80% stocks and 20% bonds. You still have decades, but you are thinking more about protecting accumulated wealth. In your 50s, shift to 65% stocks and 35% bonds. You are getting closer to retirement. Capital preservation becomes more important. Within 5 years of retirement, consider 50% stocks and 50% bonds. This protects your nest egg from market crashes right before you retire. A crash at retirement age can devastate your retirement. In retirement, start with 40 to 50% stocks and 50 to 60% bonds. You need stability for living expenses, but you need some growth because retirement could last 30 plus years. Adjust these guidelines based on your personal situation, risk tolerance, and life circumstances. These are just guidelines, not rules. Let us talk about how to evaluate an investment opportunity. When someone pitches you an investment, ask these questions. First, what is the company or investment? Second, what is the historical performance? Third, what are the risks? Fourth, what are the fees? Fifth, what are the future expectations? Sixth, why does this align with my goals? If anyone is pressuring you to invest quickly, that is a red flag. Good investments are available anytime. There is no hurry. Real investment professionals do not pressure people. Scammers do. Always take time to research. Never invest in something you do not understand. If you cannot explain it clearly, do not buy it. This disqualifies most exotic securities and certainly keeps you away from scams. Now, let us talk about behavioral patterns in market cycles. At the market trough, stocks are cheap, but everyone is terrified. News is uniformly negative. People are panicking. This is the absolute best time to invest. But psychologically, it is the hardest. Everyone is scared. The economy looks hopeless. The emotional response is to stay in cash and wait. But this is backward. This is when you should have maximum stock exposure. As the recovery begins, prices rise slowly. News is still negative, but improving. Fear slowly transitions to cautious optimism. This is a good time to invest. But it is still difficult because the bull market just started and you cannot know if it will continue. During expansion, prices rise rapidly. The economy is booming. Companies are hiring. News is positive. Wages are rising. Everyone feels great. People are confident. This is when most people want to invest. This is when they buy stocks. Prices are rising and they do not want to miss out. This is a decent time to invest because the expansion might last years, but prices are less attractive than at the trough. At the peak, stock prices are at the highest levels ever. Valuations are stretched. Investors are euphoric. Everyone is talking about investing. People are borrowing to invest. Taxi drivers and hairdressers are giving stock tips. This is the worst time to invest. But psychologically, this is when everyone wants to buy. The crowd is doing it. Prices look amazing. This is when you should reduce stock exposure and raise cash. Then comes the crash. Prices fall rapidly. The news turns negative. Fear emerges. This is terrifying. But this is actually wonderful for long-term investors. Prices are falling. You can buy at lower prices. If you have cash from the peak, now is when you use it. This is when you profit from the previous peak. This cycle repeats endlessly. The key to wealth is buying when you are terrified and prices are lowest, and reducing exposure when you are euphoric and prices are highest. This is backward from human psychology, which is why so few people do it. Let us talk about some notable historical market events. The Great Depression was caused by speculation, over-leveraging, and poor economic policy. The market crashed 89%. Unemployment exceeded 25%. It took decades to recover. Modern circuit breakers and regulations are designed to prevent this. The 1987 crash saw the market fall 22% in a single day. Computer trading amplified selling, but the market recovered within a year. Investors who bought during the crash made excellent returns. The 2000 internet bubble saw technology stocks soar to absurd valuations based on hype. Companies with no profits traded at astronomical prices. Investors believed old rules did not apply. The market always does correct eventually. When it did, tech stocks fell 70%. But investors who bought quality tech stocks after the crash became very wealthy. The 2008 financial crisis was caused by excessive leverage in the housing market. Banks held mortgages of dubious quality. When defaults increased, the entire system threatened to collapse. The government intervened with massive support. The market fell 57%. The crisis was terrifying, but it was also a tremendous buying opportunity. Those who invested in 2008 and 2009 made extraordinary returns over the following decade. The COVID crash in March 2020 saw the market fall 34% in weeks. Lockdowns caused economic chaos. Uncertainty was extreme. But within a year, the market had recovered and reached new highs. Those who panicked and sold locked in losses. Those who stayed invested or bought profited enormously. Every single crisis in history has been followed by recovery and new highs. This pattern is as close to certain as investing gets. Crashes are inevitable. Recovery is inevitable. Wealth comes to those who invest through the cycles. Finally, let us talk about the path forward. You now understand how stocks work. You understand markets move in cycles. You understand the power of compound growth and patience. You understand that simple, boring, diversified strategies beat complex ones. You understand that fees matter. You understand that time is your greatest asset. Here is what to do next. First, open a brokerage account this week. Do not wait. Do not procrastinate. Spend 1 hour comparing brokers and opening an account. This 1-hour decision will impact your life for decades. Second, determine your target allocation. How much stocks versus bonds? How much domestic versus international? Write this down. Your allocation is your investment policy statement. This is your guide. Third, choose 3 to 5 diversified funds that implement your allocation. Do not overthink this. Simple is better. A total market fund, an international fund, and a bond fund covers everything. Fourth, set up automatic monthly investing. Whatever you can afford, even $100 monthly, set it and forget it. Automatic investing removes emotion and enforces discipline. Fifth, ignore the financial news. Stop reading about the market daily. Stop watching financial channels. Ignore the noise. Check your portfolio quarterly. Rebalance yearly. Otherwise, ignore it completely. Sixth, keep learning. Read books. Listen to podcasts. Take courses. The more you understand, the more confident and disciplined you become. But remember that simple principles beat complex knowledge. Seventh, start an emergency fund. You should have 3 to 6 months of expenses in cash before you start investing. This prevents you from withdrawing from investments at the wrong time. Eighth, pay off high-interest debt before investing. Credit card debt at 20% interest is a terrible investment. Pay it off first. Ninth, maximize retirement accounts. 401k match from employers is free money. IRAs offer tax advantages. Max these before investing in taxable accounts. 10th, be patient. Wealth building takes time. You will not become rich in 1 year or 5 years, but in 10 years, 20 years, and especially 40 years, compound growth transforms modest investments into substantial wealth. Time is the magic ingredient. If you implement these principles starting today, your financial future is bright. You will build wealth steadily. You will retire comfortably. You will have the freedom to pursue the life you want. You will not be dependent on employers or government benefits. You will be financially independent. This is the promise of the stock market. It is available to everyone with discipline and patience. The stock market has created more millionaires than any other wealth-building tool in history. You can be next. The stock market is not complicated. It is not magical. It is simply a place where ownership shares of companies trade. When you own shares and companies do well, you profit. When many people invest consistently for many years, they become wealthy. This is not theory. This is historical fact. Thousands of ordinary people have become millionaires through stock market investing. You now have the knowledge. You understand the market. You understand how to invest. You understand the mistakes to avoid. You understand the strategies that work. The only question is action. Will you take the steps? Will you open an account? Will you start investing? Will you be disciplined for decades? If you do, I promise you this. In 10 years, you will thank yourself for starting today. In 20 years, you will be amazed at what compound growth created. In 30 years, you will have financial freedom that most people never experience. In 40 years, you will likely be a millionaire. This is not a promise of guaranteed returns. Markets go down, companies fail, life is unpredictable. But historically, those who have invested consistently in diversified stock portfolios have become wealthy. Your odds of success are excellent if you follow the principles in this audiobook. Now go. Open your account. Start investing. Your future self will thank you. You have everything you need. You have knowledge. You have access to markets. You have time. All that remains is action. Make the decision. Take the first step. Begin your journey to financial freedom through stock market investing. The best time to start was years ago. The second best time is today.